So Hannah and I are in the midst of the home buying process. Yes, we are moving out of the RV after 3 years full time into an actual house. We're really excited, and if there's one thing that I've learned throughout this process, it's that having a really good credit score has been extremely beneficial and given us a lot of flexibility, which got me thinking about all the different credit score myths that people believe, which is exactly what I want to talk about in this video. All right, myth number one is that if you have a good credit score, it means you love using debt. See, in certain financial circles, they can sort of play down the importance of a credit score and actually kind of conflate it with this idea that the only way you can have a good credit score is if you use a lot of debt and you love using a lot of debt. While yes, some people who do have good credit scores have gone into debt and then paid that debt back on time and have paid a little bit of interest along the way, you can absolutely have a great credit score without ever paying a dime of interest. I did that up until the point that I took on a loan for my Airstream the first time, but I had a great credit score and had never used interest before that. And while of course credit scores do help you get lower interest rates when you do need to borrow debt and make it a lot easier for you to borrow and get the best terms, they also have a host of other benefits. Over the years, having a good credit score has helped Hannah and I get approved for apartments, get utilities fees waived, and get lower car insurance rates. Credit scores are also really helpful if you have anything about your unique situation that is different. For instance, Hannah and I right now, the home that we're buying, we are getting a renovation loan because we're going to immediately do a fairly large renovation to it. We're also self-employed. Those are two things that are different than most normal mortgage loans and come with a lot more scrutiny. And so having a good credit score helps us out tremendously with that process. The main point I want you to take away from this first myth is that if you want to improve your credit score, you shouldn't feel bad about it. It doesn't mean that you love debt. Credit scores give you a ton of flexibility, which if you watch this channel, you know that I'm a huge fan of. All right, the second myth is that there's only one credit score, which is also not true at all. In fact, there's like a FICO score and there's Vantage score. Those are the two main scores that you'll hear about, but there's a host of others. And underneath the FICO score, there's actually individual FICO scores for different industries. So you have like a FICO auto score and a FICO loan for mortgage score and a FICO personal loan and a FICO student loan. And there's all these different FICO scores for different types of debt products. Layer on top of that you have a credit report, which is different than your credit score. And the credit report comes from one of three different agencies. These agencies or credit bureaus are Experian, TransUnion, and Equifax. Now, these three bureaus keep tabs on everything that you do in your financial life as it relates to debt. And so you should be able to basically look at these reports and see everything that you have going on. Now, it gets a little bit more confusing because these three bureaus don't always have the exact same information because the mortgage lenders that you use, they may not report to every single bureau. I know, it's all very confusing. But you can get your free credit report once a year by going to annualcreditreport.com, which I highly recommend doing to make sure that there's not any information on these things that are incorrect. Okay, so you've got credit scores and then you've got three credit reports. And your credit scores and your credit reports kind of work together to help a lender make a decision for how much money they want to loan you or what the rates are going to be, etc., etc. The main thing I want you to take away from this myth is that there are a lot of different scores and there are a lot of moving parts, but that's okay. Don't get too bogged down in that stuff. I just want you to focus on understanding the single main FICO score. If you can understand how the main FICO score works, which is what I'm going to share through the rest of this video, and you work to improve that FICO score, everything else should fall into place. All right, so before I talk about how the FICO score is calculated, let's talk about myth number 3, which is that checking your credit hurts your score. See, and this myth is one of those myths that it sounds right, and that's because there's a little bit of truth inside of this myth. There are certain types of credit checks that do hurt your score. Let me break this down. There's two types of credit checks. You have a hard check or a hard pull or hard inquiry, they would say, or you have a soft check or a soft inquiry. The hard inquiry is going to affect your credit score. If you have to have a hard pull on your credit, it will drop your score by 5 to 15 points, normally something like that, for a few months until it drops off. And then your score will come back up. Hard inquiries happen when you initiate a credit check to apply for a loan. So if you want to go get a personal loan or a mortgage or an auto loan or apply for a new credit card, they will do what's known as a hard pull. And that means that you've applied for some new debt and they're going to check it, and that's going to show up on your report and lower your score. This is why I haven't opened up any new credit cards over the last year, because Hannah and I knew that we were probably going to be getting a mortgage soon-ish. Once I get this behind me and I know I won't have any new big debts coming up on the horizon, I would feel more comfortable going back to opening up a new credit card if I wanted to. Now, a soft inquiry happens when you check your own credit or you use a service that checks your credit for you, or you get pre-approved for something. So if you're using any of those services like Credit Sesame or Credit Karma, or you have like Discover or Chase, and with your credit card as a perk, they send you an updated FICO score every single month, all of that is happening by doing a soft inquiry to your credit. Also, if you get a letter in the mail that says you're pre-approved for a brand new credit card of some kind, that company did a soft inquiry to check and see if they could pre-approve you. Now, you can also have a soft inquiry when you ask for a credit limit increase from your credit card company, and we're going to talk more about that in a minute. The good thing about soft inquiries is that they do not show up on your report and they don't affect your credit score at all. So the bottom line here for this myth is just to make sure that every time your credit is going to get checked, ask and see, is this going to be a hard credit check or a soft credit check? And if it's going to be a hard credit check and going to show up on your score, make sure and think about whether or not you really want that to happen, because it's going to be on your report for a little while. That brings me to myth number 4, which is that you shouldn't pay off your credit card balance at the end of the month because it hurts your credit score. AKA, you should carry debt and continue keeping debt because it helps your credit score. This myth makes me so angry, because it's just so not true, and it's another example of the financial services industry making money off of your confusion. You do not need to carry debt. You don't need to pay interest in order to have a good credit score. That is not the case at all, and you should never go into debt for the sole purpose of trying to increase your credit score. That is never a good idea. Which brings me to how this credit score is actually calculated. So let's jump over to the computer and let me show you how this score is calculated and why this myth is just not true. So to give you some context on the FICO score, I went ahead and pulled these ranges from Experian. The FICO score is calculated on a scale from 300 to 850. And this range will show you kind of what's considered, really good. And I found that as far as most lenders, if you can break that 740 range, you're pretty much going to get approved for the best rates that they have. Now, obviously, if you can break into the 800s, that's great. But first, just aim for over that 720, 740 area. That being said, let's talk about this score and how it's calculated. So you'll see here, obviously, we got our pie chart. Here's the first part. Payment history. This is 35% of your score. It makes up the bulk. It is the largest slice of the pie, and therefore it's the one that you should focus on first. Payment history basically just means, are you making on-time payments, and are you always paying at least the minimum payment that you need to make? Now, one thing I want to say about this one is that if you do miss some payments, don't feel bad. It happens absolutely to the best of us. I've missed payments before myself. But one suggestion I do have is that if you do miss a payment, and if it's a rare thing that you don't typically do, go ahead, pick up the phone and call that company and ask them to remove it from your credit report and to waive the fee. Just be really nice. Tell them, look, I'm sorry. I've been using this company for however many years you've been using it. Tell them, how much you appreciate them, and tell them, it slipped through your fingers. It's a really busy time. You're really sorry. It won't happen again. And you're going to go ahead and pay up immediately. But go ahead and ask them to remove it. Worst case scenario, they say no. But I found that a couple different times that this happened to me, I've been able to get them to drop that from my report and waive the fee. So it's always worth asking. Okay, so the next portion of the pie is amounts owed. This is probably the most confusing one, and it's also the one that most closely ties in with this myth of thinking that you need to carry debt to have a good credit score. Amounts owed has to do with what's known as your utilization ratio. And the best way that I can explain this is to try and talk you through an example. Your utilization ratio is basically the credit that you're currently using compared to the available credit that you have. So let's use a really easy example. If you have $500 currently owed on a credit card, that's how much is charged, that's the balance of the card, you have this $500 here. But if you have an available credit limit of $5,000, that would go here, you put these numbers over top of each other and you end with 10%. That means that your utilization ratio is 10%. You're currently using 10% of what you have available to you. Now, I've seen all kinds of numbers of people saying you should keep your utilization ratio under 30% or 20% or 10%. And there doesn't seem to be a consensus all around the board on what percentage you should aim for. I can tell you that in general, the lower, the better, as long as it's not zero. So obviously you do want to use the card. You want to pay it off in full every single month and never carry a balance. But if you're keeping it under 20 or 10%, that's going to give you the best opportunity to really make sure that you're, helping your credit score the most. The last thing I'll say here about the credit utilization ratio, this is more of a pro tip. So if you've struggled with debt in the past, I do not recommend this. But if you have a good understanding, if you're budgeting, if you're using your money well and you're not going into debt, one of the best ways to increase your credit score is to, again, pick up the phone, call your credit card company and ask them for a credit limit increase. Now, I actually have a whole video where I talk through an exact script that you can use to do this. And in that video, I actually filmed myself calling Discover and getting a credit limit increase on the phone with them. So if you're interested in learning how to do that, be sure to click down in the description below or right here on the screen and watch that video next. All right, we're ready for myth number 5, which is that closing an account hurts your credit, or actually helps your credit. And in fact, I've heard both of these things get argued all over the internet, and it's a little bit difficult to know which one is true. So let me jump back to the computer, show you how the rest of the FICO score is calculated, and we can kind of break down this myth. Based on the previous 2 factors, you can see how actually closing an account that has a really large credit limit could actually hurt your score, because if you close an account with a large credit limit that you weren't fully using, that's going to increase your credit utilization ratio, which will decrease your credit score. So in that scenario, if you've got an account with a really high limit that you're not using and you close it, it will hurt your score. But now let's look at some of the other 3 factors. The third factor for your FICO score is 15%, and it's the length of your credit history. Basically, this just means how long have you had an account? It's going to average all the different credit or debt accounts that you've had over the course of your lifetime and look and see how long is your credit history. So again, thinking back to myth number 5, if you close a really old account, that could hurt your score. But if you close a really new account that makes your average age of accounts older, then that could actually help your score. So if you've got a really new credit card that you're no longer using and you're looking to increase your credit score, if that new credit card has maybe a low limit and it's very new, you could close it and that would help your score. All right, let's go to the last couple of factors for the FICO score. So this one here is new credit, 10%. Basically, again, if you've got really new credit, if you got a lot of new accounts, if you've applied to a lot of things, that kind of stuff, you got a lot of new stuff, then that's going to make your score drop a little bit. And then the last factor is credit mix. So this basically means, do you have an auto loan and a mortgage and a student loan and a personal loan and a credit card and all these things? And the more variety that you have, the better your overall score. However, remember what I said at the beginning of this video. We should not ever go into debt for the sole purpose of increasing our credit score. It's important to remember that this credit mix here only makes up 10% of your overall score. So if you nail all these 4, 90%, you're going to have a great score, even if you don't have a large credit mix. The bottom line with understanding how the FICO score works, if you're really trying to improve your score, are these 3 keys. Make on-time payments, keep your utilization ratio low, and keep a long average account history. Just be patient. If you do these 3 things, that makes up 80% of your score. That's the green, red, and the blue here. Do those 3 things. 80% of your score is going to be rock solid. You won't have to worry about that other 20% that much, and you're going to have a fantastic FICO score. All right, so if you like this video, be sure to check out that other video where I called Discover and got a credit limit increase. I think you'll find it really helpful. Thanks so much for watching, and I will see you over there.